And to help us put sense into all this is our market master of the day. Nilesh Shah, Managing Director and CEO of Axis Capital, is our guest. Good morning, Nilesh. Thank you very much for joining us. Well, first I'm going to ask you a near-term trading question. The market is pretty close to its all-time highs. Can breach it if it extended by another 50 points. What is the sense you are getting? Are there near-term gains for this market, or are the gains going to be more back-ended from here on?
I think we are at the stage where after the rally of last couple of months, we are entering a phase of consolidation. So it's more likely that the gains from here onwards will be a little bit back-ended rather than completely front-loaded like it was in last 6 months.
Okay. What are your takeaways from the Prime Minister's speech, Nilesh? I was impressed by or at least what stood out for me was the emphasis on Make in India, on manufacturing, and on import substitution, export promotion. As a market man, how will you make sense of all this?
So clearly from a market man point of view, the Make in India is something which is very, very comfortable to the market. We are an economy which kind of transited from agriculture-based economy to services-based economy, whereas the manufacturing base never developed or never contributed as much to the economy which we have seen in other parts of the world. So clearly we need to create employment, we need to create jobs, and that's the virtuous cycle which market is looking forward, where today you have more jobs which results into more income, which creates more savings, more investments, more demand, and ultimately more growth. So that Make in India concept is something which market will be favorably looking forward to. And as they mentioned that, well begin is half done, but in India's case the execution is more critical than just the intent. So what steps government take on ground to kind of remove the new license permit raj of land, employment, labor laws, and so on and so forth, that's what market will be looking forward to.
Nilesh, hi, good morning. Good to see you in as always. The consolidation phase has actually begun. If you look at the performance months to date, August has been very flat for us. But within this consolidation as well, if you look at some of these plays on the domestic recovery, so whether it's autos, whether it's cement, whether it is a couple of FMCG names, these are the spaces that have done well this month at least. Do you think these are the sectors that will take the market higher in the next leg of the move?
So in this consolidation phase, couple of things stands out. We have seen some of the cyclicals coming down by between 10 to 15% from the recent highs to current market price. These are across sectors like infrastructure, power, domestic cyclicals, and so on and so forth. Whereas some of the stocks which were defensives in IT, pharma, and FMCG, they have actually moved up. So this trend or rotation has kept the Nifty where it is, but the stocks in turn has moved by 10 to 15%. The second consolidation which is appearing is what you mentioned very rightly. So we are in a phase where market is trying to look at the results which have come very positive, are also looking at the supply pipeline which is looking quite large. They are also looking at divestment, which is a large number. They are also looking at global environment, which is not probably as conducive as it was some time back. So all these things is kind of keeping market on tenterhooks, and this is where the sector rotation will become critical. This is where the stock picking will become critical. And as I mentioned earlier, now it's the stocks which are going to give the return rather than the broad market movement.
That's a fair point, Nilesh. Therefore, where would the outperformers lie? Say, for instance, in the Nifty itself, would you go with the defensives which have led over the past 8 weeks, or do you think it's time to dip into any of the cyclicals at all?
So you'll have to be more of a core and settle-like portfolio. The core portfolio will still continue to be those bottom-up stocks across defensive sectors where valuation seems to be reasonable. Clearly, IT sector today is facing the headwind of one, the guidance given by Cognizant in terms of lower growth, vis-a-vis the depreciating rupee, which is again going to support the IT sector. So within this, wherever the valuation and growth equation is in your favor, that probably becomes a top part of your portfolio. Similar allocation can be done within pharma and FMCG to those companies where valuation versus growth is still reasonable in your favor. And the underperformance of FMCG sector creates a great opportunity to invest into that sector. So this becomes part of your core portfolio. Bulk of the June quarterly results profit has actually come from this sector. The profitability trend is good. Volume should come back with the consumption pickup. Rupee should also support some of the export sectors within this three. So net-net, this becomes part of the core portfolio. And then the sector rotation happens in the satellite sector, where we are seeing some amount of domestic cyclicals which have kind of fallen by 10 to 15%. At this price, they become a trading buy. Not necessarily a long-term investment call, but certainly from a sector rotation point of view, this becomes a trading buy. So one will have to use this core and satellite approach between defensives and cyclicals in order to create outperformance in the market, which is more likely to be range-bound rather than just trending up.
10 to 15% cyclical stock, that's foreign. I can only think of L&T. Nilesh, you won't talk stocks, so I'm trying to read between the lines.
There are many names in PSU Bank also which has fallen by 10 to 15% from their recent highs.
Okay. Actually, I was going to develop my question into financials as well. What part of your portfolio, if you had 100 rupees, would be invested in banks or finance companies?
So within bank and finance company now you have kind of again core and satellite approach. The longer term history does suggest that private sector banks and NBFCs have outperformed PSU banks by a big margin over a longer period of time. So your core portfolio will be divided across the private sector banks and NBFCs, and especially again you will have to keep a look or watch out on the valuation. The satellite portfolio will be across those PSU banks which are available below the book and where the concern on NPA or the book or the management is not very, very high. So clearly one can again create a balance between core and satellite approach, but this is probably the time to look selectively at the PSU bank from a trading point of view.
Okay, that's an interesting point there. Actually, the market is also moving up higher right now, so it's back above the 7,800 level on the Nifty. Not by a whole margin, but nevertheless, these levels have been scaled, and the mid-cap index, by the way, is up about 0.5%. Nilesh, apart from the PSU banks, names like SBI and PNB that have corrected 5 to 10% this month, and you just spoke about, there are other metal names too, names like Hindalco, Tata Steel, etc., that have been very strong performers, but this month there's been a consolidation with a negative bias. Would you buy any of these names at this juncture?
So in the metals, the story will be far more company specific rather than top down. I mean, clearly each company is at different stage of growth path and each company has differential strategy. More importantly, in the metal sector, it's no longer an India play anymore. It's diversified across globe. So you'll not only have to consider the local factors but also the global factors, and that makes this case interesting as well as complex. So on the metal case, we are far more bottom-up stock specific rather than top-down, and selectively, yes, within the metal sector also there are stocks which are good play purely because they are kind of available at a very, very cheap valuation vis-a-vis their fair value.
Okay. Why did you say that PSUs are a trading buy, PSU banks?
One, from a valuation point of view, they are all available at a reasonable discount to what was their peak valuation from a price to book point of view. Second, today, most of the PSU banks kind of move in a herd. So when they go down, they all go down between 5 to 15%. When they go up, they all go up in similar range. Now, clearly, there are different style of management within the PSU banks, and they all don't have the same problems on NPA side. Some banks have done better, some banks have done worse. So probably from a trading point of view, when the whole lot is punished for a particular reason, it makes sense to add certain positions in those well-managed PSU banks where valuation is your favor and management is also working for you.
Okay. Well, Nilesh, on that issue, I wanted to ask you about the inflation numbers as well. You're a close watcher of the money markets. That disappointed seriously. We had some economists speaking to us on Ingenomics over the weekend, and all of them saw the first rate cut probably 12 months away. So next July, your own thoughts, and what should stock markets worry at all? Or is it an issue the stock markets don't have to bother about?
No, definitely stock markets have to worry about what will be the RBI's monetary policy. Now, why stock market today probably not reacting as adversely to the postponement of interest rate softening as one would have expected? If you see the June quarterly result, the interest cost as a percentage of sales has actually come down. Now, this has happened despite policy rates remaining where it is. So probably what has happened is that one, the companies have become working capital efficient, or the overall cost of borrowing for them has come down despite the policy rates remaining where they are. Now, either this is happening because they have used the domestic borrowing versus foreign borrowing in a judicious manner, or they have actually reduced the cost of borrowing despite policy rates remaining where they are by changing the mix of their short and long dated borrowing. So market, watching the June quarterly number, is feeling comfortable that even if there is a postponement of interest rate cut, doesn't matter, the companies are taking their own way of managing interest rate cost. But certainly, if in September quarter or December quarter we don't see that trend going forward, then markets will start looking forward to what happens on interest rate side. Second, from a pure valuation point of view also, when markets are trading near their fair value, the investors will be evaluating both debt and equity as an investment option, and the retail investors have indeed come back into equity market in May, June and July. But if the interest rate continues to remain on the higher side and equity markets remain at fair value, who knows, their flows can get diverted towards fixed income also. So even from a flow point of view, markets will be keenly watching what happens on interest rate side. The third is again then the overall valuation of the stock market. Clearly there is a link between stock market valuation and interest rate, and if market believes that interest rate softening is far more back-ended than what they were believing previously, then there could be an impact on valuation. So look at whichever way, markets will be keenly watching what happens on interest rate. As of today, the June quarterly results have probably given them comfort to not withstand the back-ending of interest rate cuts.
Right, we have a query actually that's posted on our Money Control message board, Nilesh, so I'm going to throw that to you. It comes in from a gentleman who writes, called Sanjay Bose, who writes that which asset class is looking most attractive at current levels? What would your answer be?
I still think that equity looks fairly attractive from a current valuation point of view. We are at a stage where probably markets are on a multi-year bull run, so we are passing through a consolidation stage for the time being. And that consolidation gives you a great opportunity to enter into a market. It's a buy on dip market, and I have no doubt in my mind that over next 1 year, 3 year, 5 year, equity should continue to outperform fixed income, gold and real estate within the domestic asset class.
Some numbers, Nilesh, we have a lot of estimates out there about 8,500 and 9,000, maybe 10 months down the line, 12 months down the line. What is your 12-month expectation from this market? Also a word on earnings growth for the current year. What are you working with for 15 and 16, and will we see upgrades or downgrades?
My feeling is that the June quarterly result will actually force a lot of people to upgrade their earnings cycle. I mean, overall, when we begin the year FY15, people were on an average between 15 to 16% in terms of earnings growth. The June quarter itself, partly due to the base effect and partly because of the cost-cutting measures by the companies, have seen expansion in operating margin and have seen profit growth, which is reasonably high. So clearly, the first quarter has given the boost to the numbers, and we will see upgrade cycle coming through. The second thing which we are also seeing is that monsoon has recovered reasonably well, and while we were facing a drought kind of situation in May and June, July has been fantastic. So that delayed recovery of monsoon will also result into some earnings upgrade, especially in the agriculture related and rural economy related sectors. Put these two things together, we will see earnings upgrade cycle in days to come, and that will also support the valuation of the market in the current cycle.
All right, Nilesh, I think we've run out of time, but thank you so much for joining us and giving us your views. That's a positive and optimistic view coming in from Axis Capital. They believe that there will be a bit of a consolidation phase, but this is still a multi-year bull run that the Indian equities are trading in.